All right, guys, why don't we get started, because we are in for a lot of riding tonight, okay? We're gonna push the pace tonight, okay? So everyone get ready, because we've got 3 more classes, I think, right? Everyone do your computation, so I know where I want to be by the end of the semester. And again, good news for your team, we're not going to finish the entire textbook, but I owe it to you to complete the life cycle of a partnership. So we have to bring it into being, we have to operate it, and we have to liquidate it. I will not feel like I've done my job unless I give you the complete life cycle. So that's why we're going to try to pace ourselves. It's going to be like the New York Marathon today. Okay? So get ready. All right. Bearing that in mind, very short review, and then let's just get going with the new material, is that you guys can form a partnership. And the good news is some of the stuff that we pick up towards the end of class today, talking about distributions, should reinforce some of the stuff you have learned about contributions. That there's some yin and yang going on. So just bear in mind, this is going to be a good exercise to reinforce some of the stuff that we've looked at throughout the semester. So you can form the partnership 721, 722, 723, 724. You can operate the partnership, and you can deal with the code sections that deal with, as I mentioned to you before, special allocations. You have to be careful about code section 704C. Comes up all the time. We talked about traditional method, traditional with curative allocations, the remedial method, all sorts of fun and games like that. We talked about family partners, code section 704E. We talked about payments made to partners, okay, in 3 different capacities. As a non-partner, 707A1. We talked about guaranteed payments, 704. Is it 704 or 70? You can say it. Fill in the blank for me. 707C, right? Guaranteed payments, and then distributive shares, right? We have 3 different ways of viewing payments for services, and then Chapter 8 deals with property transactions between partners and partnerships. I've said this before. I'll say it to you again. I'll say it 100 more times to remind myself, to remind you. Anytime you have related party transactions, you got to be circumspect. Congress, for example, sometimes disallows losses, sometimes changes the character from capital gain to ordinary income, and sometimes treats transactions as if they're disguised sales or disguised payments for services, because in lieu of capitalization, people are trying to expense what otherwise might have to be capitalized. So we looked at that in the last chapter, all right? And that brings us very quickly up to Chapter 9, okay? And Chapter 9, just to remind ourselves, deals with sales and exchanges of partnership interest. And just to again, from 30,000 feet up, the notion is, what is a partnership interest? What kind of asset is it? You look quickly at code section 1221. It doesn't look like it falls within the scope of being a non-capital asset, okay? Admittedly, it doesn't. 741 seems to say treat as capital gain, but when you look at 741, it says treat as capital gain except as otherwise provided. Obviously, I'm paraphrasing with respect to 751 assets. 751 at the water cooler. You may also refer to 751 as hot assets. Hot assets that are typically accounts receivable and inventory. Accounts receivable and inventory, and bear in mind, inventory would include 1245 recapture income, and 1250 recapture income is going to fall within the scope of getting 751 treatment, okay? So essentially, Congress demands a look-through. You cannot just put assets into a partnership and hope to command capital gains rates. Notwithstanding the new tax legislation does little to toy with tax rates. Okay, does little to toy with tax rates. I mean, it does adjust takes 7 rates, makes them into 4. But for our clients, many of them are going to be subject to the same 35% rate or 39.6% rate. And the capital gains rate, unless you guys correct me, I don't think there's been anything done to change that, right?
They tweaked the bracket slightly, but the rates are the same.
Say again, Joe?
So they tweaked the bracket slightly, but the rates are the same.
Tweak the brackets, but capital gains, they've tweaked those brackets too?
Oh, just to correspond to the
Okay, just to correspond. And we'll see. The Senate bill is supposed to be released tomorrow. Needless to say, I will be very curious. I suspect, I hope you guys will too. We'll see if there's any notion of a carryover basis. You're going to eliminate the estate tax. Certainly it's something Congress should consider. Well, we'll see. Good news, I said this my income tax class, I'll say it here. Very little has changed in the partnership sphere, albeit the original House bill had nothing about carried interest. Apparently there was a write-up. Ken Brady changed that carried interest not held for more than 3 years would be treated as ordinary income. We'll see. There's a lot of, you will not be held accountable for that, okay? I'm just telling you there's some movement, and whether that the tax legislation passes at all is a big issue. All right, so the authors, they want to talk about, I want to talk about, clients mention all the time, selling partnership interest, right? And if it's a hot asset, it's a hot asset. On page 287, the Glazer case talks about taxpayers disguising inventory, trying to get capital gain treatment for inventory. And the Ledoux, if I said that correctly, the Ledoux case on page 291, taxpayers trying to camouflage accounts receivable as capital gains, and the court peered through that and said no, that should command ordinary income treatment. All right, and that brings us up to page 299. Okay, page 299, and we went through the problems. I promised you that I thought it would behoove us to go through 1 or 2 of the preliminary problems, because I hope that would make your job easier to go back and try some of the later problems, because you could see stylistically what we were doing. I hope some of you took that opportunity. Here's our agenda for tonight, guys. My goal is to finish this chapter in its entirety and then to get through the first part of chapter 10. Now, bear in mind, chapter 9 comes in 2 flavors. Here's the 2 flavors. Flavor 1 is, and this is important for the exam, what are the consequences to the seller? Okay, we are looking right now at the consequences to the seller, right? Everyone agree? And normally, can I make the observation, when we look at consequences to the buyer, is that a pretty nothing issue for most times when we talk about issues to buyers? Usually, what's the conversation? It begins and ends with, oh, what's the person's cost basis, right, Dill? Code section 1012, we're done. But that's not the case when it comes to partnerships. And you'll see, it's much, much more complicated, okay? So outside the sphere of context, outside the context of partnerships, basis or the issues pertaining to buyers, there's not a non-issue generally. But when it comes to partnership, there's a multitude of issues that need to be addressed. Right? So everyone, again, 2 parts right now. This chapter dealing with the seller and dealing with the buyer. And again, normally with the seller, not a big issue, right? We look at the kind of asset they're selling. We apply code section 1001, figure a gain and loss, put a character, we're done. But notice that that's not true with partnerships. Something as simple as a sale requires multiple steps. Agreed? So again, everyone see that sale or exchange normally outside this context, pretty straightforward. You put it in the context of a partnership, much more complicated. All right. So, any questions, logistically or otherwise? Page 299. Let's review the problems we went through and then go forward. All right. All right. Partner A owns a 1/3 interest in ABC. Cash method, calendar year, general partnership, manufactures and sells inventory, A, B, and C, the original partners, each made an initial cash contribution, 721 transaction, right? $75,000. Okay, that's going to also be their outside tax basis. On January 1st, A sells his interest to new partner D. We've got to consider the consequences, not to partner D, not to the buyer. That's going to be the second half of the chapter, but the consequences to the seller. Okay, and we're told that he sells his interest for $135,000 in cash. And we said, even though I said it's a pas de trois, it's a pirouette, three-step process, whatever you want to call it, I'll leave it up to you. Certainly dance is not my strength. In fact, there's a long list of things that aren't my strength, but putting that issue aside, we got to first determine the gain. Everyone agree? Step one, get the numerical answer right? Everyone here should have no problem getting the numerical answer right. Akin to code section 1001, what's the amount realized? What's the adjusted basis, right? Gain or loss, right? So, in this problem, that's $135,000, that's the amount realized. Its basis is 75. Everyone knows the gain here is 60. Second part, second step. The statute says pull out the 751 gain. And we know that's comprised of the inventory and accounts receivable, his pro rata share, and he's got $5,000 of gain embedded in the inventory, $15,000 of gain embedded in the accounts receivable. Add them together, that's $20,000. Okay? Whatever the difference is, step 3 says it's going to be a capital gain. So 741 capital gain here is $40,000. Any problems? If you can't do problem A, the rest is going to be much more challenging. Everyone understand where these numbers came from? Any problem with this? Okay, step 2. Problem B. Each partner originally contributed $150,000 in cash, and assume each has $150,000 outside basis. And the capital asset has a $330,000 outside basis, right? Which means it has an embedded loss in its entirety of $105,000, right? So basis of 330, fair market value of 225, total embedded loss of 105. A sells his interest once again for 135. Well, this time there's a $15,000 loss, right? Everyone can handle the math. Agreed? The amount realized is 135. The basis is 150. Loss of 15,000. Step 2. What's the ordinary component? We got to pull out the 751. Ordinary income. We pull it out. 20,000. Numerically, that outcome has not changed, right? And whatever the difference is, it's going to constitute the 741 gain or loss here. Capital loss. This capital loss is going to be subject to the capital loss limitations under, right, code section 1211. And then we have the 1212 carry forwards, right? Everyone good? Everyone can handle this. And this is where I believe your notes left off. We began problem C last class. I don't think we finished. Okay, ready to move forward?
No, I don't understand step 2 how to get the 20.
What don't you understand?
Step 2.
Step 2 is the embedded ordinary income. The inventory has how much? 15,000 of embedded 751 gain, right? And his pro rata share is 1/3 of that, right? Or $5,000. Agreed? The accounts receivable embedded gain is 45, right? His pro rata share is 15. What's 5 plus 15, Louise? 20. You got it? All right. You guys ready to look at problem C? Okay. This time, each partner originally contributed only $45,000 cash instead of $75,000, and the capital asset was purchased and held subject to a $90,000 liability. A sells his interest to D for $105,000 of cash. Okay? So in this case, we have our same three-step process. Same three-step process. I don't want to use a red marker. So what is the amount realized here, guys?
135.
Say again?
135.
135. Why?
Because the 105 in cash and the 30,000 of the liability that is owed to A.
Right. It's 135, right? Because it's not only the cash received, but under Crane, it's the amount of liability, right? Purchaser's taking the property subject to liability. What's the basis here?
75.
75. Why is it 75? Because the liability, right? So the gain is 60. Guess what? The outcome is going to be the same as in A, right? Louise, you got that? It's the same outcome as in A because we had the same 751 gain and the same 741. Once we know this is 60, right? Step 2 and step 3 are going to yield the same outcome. It's going to be 20, and it's going to be 40. Right? For the exact same reasons. Why did the authors put problem C here? Just to illustrate if property is subject to liability, that's considered part of your amount realized, and how your outside basis is adjusted under Code Section 752. Question D. The sale occurs on March 31st, 1/4 of the way through the year. The time when A's share of the partnership income through March 31st is $30,000. It is agreed that D will pay $165,000 for his interest, will also acquire A's right to the income. Now bear in mind that one partner is selling his interest, right? Does the partnership year close on March 31st as a result of this sale? And the answer is no. Code Section 706C1. 706C1 says the partnership year does not close, but it does close for the partner who terminates his interest, 706C2A. I'll repeat. 706C2A says it does close with respect to that partner. Okay, so partnership's year is not going to close, but the partner's years will close. What happens? Will partner, who's selling his interest here? A. Will partner A have to include this in his income, the $30,000? What do you think? Will he get a K1 for $30,000? Yeah. He will get a K1 for $30,000 because that was what was earned during his first 3 months, right? Now, what does that do to his outside basis, guys? Goes up, right? Code Section 705. Everyone agree? So, first two things. Again, he has to include $30,000 of ordinary income because, as to him, the year is going to close, and his basis goes up by $30,000. So, what's his amount realized here, guys? We're going to do our three-step process. Step 1. Say again? 165. What's his basis?
105.
What's his basis?
The original 75.
What? I'm sorry. It's 75 plus 30, so it's 105. Yeah. Okay, I got it. So its gain here is 60. Everyone agree? Okay. And then Step 2 and step 3, we know where this is going, right? We're going to, right, Louise? It's going to be 20 and 40 again, right? We're going to pull out the ordinary income, and whatever's left has to equal 60. All right, everyone see how this adjusts his outside basis?
That bit about D acquiring age right to the income, that's just irrelevant for Deborah, right?
Well, he's going to, that's why he's increasing the purchase price.
Okay.
Because he's going to get that $30,000 more.
Oh, okay.
Okay, that's why he's willing to pay that.
Oh, okay. So it's not actual income to him.
It's not actual income, but he's increasing the purchase price as a result.
All right.
All right? Ready to do question 2? So this, guys, is just designed, and for exam purposes, if you don't mind me saying, problem 1, no one gets mad at me if we have some similar kind of arrangement, right? Everyone can handle this. If you can't, get back in touch with me. Tell me what you don't understand. But this is the kind of thing that comes up in practice all the time. And the greatest problem I see personally is accountants and lawyers and clients generally see this as saying, oh, you're selling a partnership interest, capital gain. Okay? So just keep in mind, 751 is like, if you don't, I don't know if this worked for you. It's very similar, at least to me, like Code Section 1245 kind of thing. You know how we think 1231, 1245? When you think, to me, peanut butter and jelly, 741, you think 751, right? Everyone see the connection? All right. Question 2. Assume the same basic facts in 1, except that ABC partnership, now we're going to turn it around. It's an accrual method taxpayer. So those accounts receivable, guys, have already been taken into income, okay? So they have a basis equal to fair market value. The basis will equal fair market value because it's an accrual method taxpayer. And as a result, right, Louise, A has to recognize his pro rata share, and that's why his basis is going from 75 up to 90. It's 75 plus 15 because the accounts receivable has already been taken into income. So do you see why his outside basis is now 90, Louise? Okay, everyone's good? Everyone else sees it too? For each part, determine the amount of 751, only that amount of A 751 ordinary income. A sells his interest to D. No, I still did the 3-step process because why not? And we're told it's sold for 135,000 because it's the same facts as an A. Okay, so let's go through our three-step process. So we're doing problem 2A. Step 1. What's the gain or loss here, guys? What's the amount realized? 135. Music to me years. Less what? 90. Gain or loss? Gain of 45, right? Step 2, right, is to pull out the 751 gain, which is how much? $5,000, right? Step 3 is how much? 40,000, right? Everyone agree? That equals 45. Step 3 is going to be the 741 capital gain. Everyone got this, right? The authors are just trying to illustrate the difference between a cash method partnership versus an accrual method partnership, right? With an accrual method partnership, chances are, barring extenuating circumstances, you may have no 751 attributable to the accounts receivable, right? Question B. What results in A if the partnership held inventory as a capital asset, but A is a dealer in that type of property? Right? A is a dealer in that kind of property. Is the inventory a 751 asset? If it's not inventory in the hands of the partnership, but it's inventory in the hands of the partner. And you might say, should be inventory, right? But 751D3. 751D3. Let's take a look at how inventory is defined. For purpose of this subchapter, the term inventory item means, look at 3. Any other property held by the partnership which, if held by the selling or distributee partner, that's A, right, would be considered the property of the type described in paragraph 1 or 2, which is inventory. So is this inventory for purposes of code section 751, guys? Yes. So it's kind of a surprised answer, right? You wouldn't think about this normally, right? So what this means is the answer is the same as above.
So if B or C sold their interest, there wouldn't be, and they're not dealing.
Right.
Okay.
B or C sold it, it would be capital S.
Capital. Okay.
Is there a time period on this, or A would have had it in last year? Are they telling you this year?
It's silent as the time period, just whenever it would. It's not like 724 with a 5-year period or anything like that. Assuming it would be inventory in his hands. Okay. Question C. What result in A above? If the partnership owns no inventory, okay, doesn't look like there's any 751 assets, right? Owns no inventory, but has a 50% interest in another partnership 2 that has only assets that are inventory with a basis of 150 and value of 180. Okay, so it doesn't own any directly, but it owns an interest as a 50% partner. So this is a tiered arrangement. Everyone agree? There's a lower tier. And Eric, what do you think the code has up its sleeve in this case?
Definitely retains its character. Don't know the code.
751F. 751F says peer through the tiers. And if it's a tiered arrangement, make those tiers disappear and treat it as if the partnership owned it directly. So the outcome would be the same. What's my authority? Code section 751F.
Because they use double numbers. Okay.
Question D. What result in A above if in addition the partnership had a contract worth $30,000 to perform real estate management services for the next 10 years? Okay. So, what do you think the authors are driving at here?
That's ordinary income producing property, right?
Well,
Right.
looking at the Ladeau case, you remember the Ladeau case with running or operating a dog track? I think it was a dog track, right? And the payment in part was relating to a management contract. That was considered an account receivable.
Right.
So here, what we would do, the answer to D is not only we would have our same $45,000 gain under step 1, but step 2, we have the $5,000 gain on the inventory, but now we have a $10,000, right? His pro rata share of the contract would be $10,000, so we would pull out 15 in step 3. would be the difference, or 30,000. Again, where did I get the 10,000? That's 1/3 of 30,000, because here the seller, right, is selling implicitly their 1/3 interest, right, in this contract akin to Ladeau.
And it's safe to use that full $30,000 since it's over 10 years and all. I know we don't have better information here, but.
Let's just assume it is, just for, I would not get tricky here.
Okay.
So what, can you go over what the numbers are for this one?
What's that?
I only got the 10,000.
Well, the gain here is going to be the same, of 45. Step 1 is the same. Step 2, instead of just being the inventory, even though they're an accrual method taxpayer, they don't accrue this contract into income. It's services to be rendered. But nevertheless, it counts as an account receivable. So his pro rata share of that, the pro rata share of the inventory, the 15,000 of inventory is 5. His pro rata share of the contract is 10. This is 15,000 of ordinary income. This is capital gain, the 30,000 balance. Ashley, you good? All right.
For C, the gain is 45. How about step 2? Is it still the same if the inventory is 180 for market value 150?
Say again.
For C, you said it's the same.
For C, problem C.
Yes. Why is it the same?
Why is it the same? Because again, we're assuming a tiered relationship. I mean, that's the only thing the authors are showing us under Code Section 751F. That's it. Don't.
But I see a gain of 30, 180 minus 150.
No. But that's, first of all, they only had a 50% interest.
Oh, okay.
So it's half of that.
Half of the 30.
Half. Okay? So that means they had basis of 75, value of 90. So it gets us at the exact same place. Okay? All right. Again, guys, this is what I care about. That you can look at these two problems. The authors are about to get a little bit more complicated. Don't look for, I'm going to be happy if you get this, okay? Because a week, a month, a year, 10 years from now, after you leave this course, I would be happy if you paused. If someone said they sold their partnership interest, that you paused and said, gee, it may not be all capital gain. I will consider that a personal victory. The fact that there may be different kinds of capital gain, okay, maybe you will or won't remember that. But at least if you get this, the important part, 751 can come to haunt you, right? If you forget it, because there's a vast difference in the tax rate, and that vast difference in tax rate is apt to continue for the foreseeable future. Okay? I will point out, this was something interesting I didn't pick up. I can't resist, maybe you can, but I can't. Like, every time I go on Google News and there's a new article about the tax proposal, what I picked up, and I don't know, this is somewhat unique. There's one or two other areas I've seen this. But do you guys know what happens if you earn more than $1 million and you're not at the 39.6% rate? Anyone know that you lose the dollars that were going to be taxed at 12% are now taxed at 39.6%? You lose the lower tax rate? And anyone know a similar code section where that happens, where it's sort of the code forces you into higher brackets once you cross a certain threshold?
That's on the corporate side, isn't it?
With corporate side, right, you lose code section 11, you lose the lower brackets. There's a bubble that causes you to go up. So good point, Dale. I was thinking of something else, but fair statement, code section 11. Some of you may recall, some of you had made for international tax, and there's code section 911 that allows you to exclude certain income from your tax base if you work overseas. And code section 911F, I believe, if you do, whatever income you earn above that threshold, you're putting a higher tax rates. Like, it forces you as if that income, even though it's exempt, had it been taxed. So it's kind of interesting. Did you guys know about this 39.6% that there is a clawback, that you lose the 12% rate?
I read the words clawback. I didn't know what it meant.
Now you do.
I think
right?
I read somewhere that
You're losing a lower rate at even less than $1
I
million?
read that somewhere, I think maybe.
Okay, but you guys know my philosophy. I love reading this stuff, but I draw like a mental limit that I don't want to read too much because I don't want it to like cloud what's reality. So Kelly, you may be right, but these little tidbits are irresistible to share with you. All right. All right. Anyone have a tidbit they want to tell me that they said couldn't believe it? And maybe I shared this one with you, go ahead, Jonathan.
They're limiting further expenses for entertainment, and they're also.
What was the limit? I saw something about that 274A1A. I believe there was a limit. I saw that, but it didn't appear.
I don't know the exact details,
Okay.
but I know that they're trimming down. And the other one I thought was interesting, or two actually. One, the endowment tax.
You mean on college endowments, 1.45%.
And the other one really interesting though is the excise tax they're including for executive compensation of $1 million, but and a higher one for exempt entities.
All right. I saw bits and pieces. The other thing, two other things, again, can't resist it. Many of you are here or able to avail yourself of Code Section 127, right? Okay, employer-provided education that allows you to exempt $5,250 from tax, right? Do some of you take advantage of that in this room? Do you know that gets repealed? And personally, what cuts like a knife for me, but I may have mentioned this, so I apologize, I hate repetition, but they eliminate the $7,500 tax credit for electric cars. I was counting on that. I was the first guy who ordered Tesla 3, and I really don't feel like paying an additional $7,500 for it.
So when is the education repeal? It's effective one?
I think January 1st.
No, at least this year, reimbursement for this class until they get, usually January 31st paycheck. Because usually my first class is like fully reimbursed, the second class I get 2 different wires, up to $250.
Listen, this is not a fait accompli, but for Congress, this is low-hanging fruit. All right, for that. Unlike the Koch brothers, you're not going to put up billions to protest, right? No one in this room. So, anyway, those are some other tidbits. I didn't mean to ruin anyone's night. Just brace yourself. And if there's a way to ask your employer, I don't know. I mean, for some of you, you've already used it, but if there's new people here, get that money reimbursed before year's end. Okay? All right. So, capital gains look-through rule.
So we need the result earlier.
I'll deliver. I mean, I got to submit the grades before year's end. What that means to you, I don't know. Okay? Capital gains look-through. Okay? We know capital gains come in different flavors, right? There is the regular capital gains rate. There's the unrecaptured capital gains rate of 25%. There's the collectible capital gains rate of 28%. So there are different capital gains rates, and the code is trying to be sensitive to them. And this is found, by the way, guys, the authors were not being original. I just wanted to quote, if you look at regulation 1.1H-1A, there's several examples under that. This is on page 301. There's 3 different examples. The authors, again, very unoriginal on their part. I probably, for exam purposes, will not get fancy with different capital gains rates. I just want you to get this, okay? So this next problem on page 302, just use it as a problem to reinforce this. I don't envision having an exam question where they're going to ask you about different capital gains rates. Don't get disappointed. But again, this is what I want you to take. So just look at problem 302 on page 302. We have AB, equal partners in personal service partnership. The partner acquired a partnership interest for cash several years ago. None of the assets are 704C. The partnership has the following balance sheet. Okay? Consider the tax consequences to be under sale of each of the following. So B sells her interest for $15,000 cash. Okay? And keep in mind, there's liabilities here of $2,000, and notice the asterisk. It says basis figures represent each partner's outside basis, including their share of liabilities. So the outside basis already includes that. Everyone see that? That's important. So let's do this first problem. And let's do our three-step process. Nothing fancy, guys. Step one. What's the amount realized?
15.
Don't say 15.
Plus the share of the liability.
Plus the share of the liability, right? So the amount realized is 16. What's the basis? 10, right? Because the authors told us that, right? What's the 751 gain here, guys? Take a look. 50-50 partner, not designed to be tricky here. 751 gain, guys? 7, right? Everybody agree? That's the receivables. So that's a 751 ordinary income. What do you think our 741 gain or loss should be here? Betty, what do you think? 741 gain or loss here, Betty?
I think it's
Loss of how much?
1,000.
1,000, right? Because we know we got to equal 6. Now, again, for my purposes, guys, I'd be happy for exam purposes you get this, okay? The authors will tell you that if you look at example 1, that I just, in regulation 1-1.1 H dash 1F, example 1, they will depict this as there's a 1 gain in the collectible and a $2,000 loss, right, in the other capital assets. So if you do the arithmetic, this would break down that you would report 1K collectible capital gain and 2K long-term capital loss. It all adds up, but keep in mind, again, it's treated as a conduit entity, right? As you look through it.
Excuse me. I'm kind of lost. The 7,000 comes again.
That's the receivables. 50% of the receivables. Okay? Anyone else not see a number here? Again, this 1,000 capital loss, the authors say, the regulations say we have to consider between the collectibles. I mean, do you see how silly this is that our country has 3 capital gains rates? So, but that's where complexity comes in, guys.
Specify where.
Say again, say it loudly, actually.
Specify where you got the 16.
Where I got the what?
Why do you add 1 to 15?
Because it's 15, right? Plus, you're shedding 1K of liabilities under Crane. All right?
And that's even if it's a non-recourse liability where you're not liable for it at all.
That's definitely. Okay. That's Tufts. Okay. That's the Tufts decision. In Tufts, they weren't liable. They walked away from the property, considered amount realized. Okay. Okay, if you look at the regs, recourse or non-recourse doesn't matter for amount realized. Okay. Question B. B sells her entire interest for $16,000 cash, and under the partnership agreement, all gain from the sale of collectibles is allocated to B. So B is going to pick up all the gain on the collectibles. Okay. Now, Ashley, what is step 1, the gain or loss here in this problem? This is A. B. What's the gain or loss, Ashley?
7 minus 10.
Which is 7. Everyone agree? You sell it for 16, but you're shedding 1,000 in liability. The gain is 7. So step 1 is 7. Everyone see that? Same principles as before, right? Step 2. Ready? What's the 751 gain?
It's the same, like I said.
Absolutely the same. I just wanted to hear you say it. Step 2. It's 7,000, right? So what does that mean, step 3? 0. Everyone can handle that math, right? But, again, just to make your life complicated, an example 2 under that same regulation, guess what? It says he was supposed to take into account the collectibles, so he has to pick up the $2,000 of collectibles here, the gain on the collectibles. It's deemed that he would pick up the gain of $2,000. And that being the case, we got to get him back to 0. So we'd have $2,000 of gains of collectibles. And he'd have a $2,000 offsetting capital loss. You can't make this stuff up. It's straight from example 2 in the regulations. Let me repeat. Even though he has 0 as his 741 gain, he must pick up $2,000 per the agreement, $2,000 of the gain of the collectibles because he agreed to pick up the collectible gain. But to get it back to 0, we're going to have to plug in $2,000 worth of regular capital losses. Joe.
Forgive me for going back, just part of covered it, but if the inventory or AR has an embedded loss in it, how does that change our calculations?
If the inventory or accounts receivable?
If the 751 assets theoretically have a...
Then you may have a larger or smaller 741 gain or loss.
Okay, so it's still ordinary.
You still, definitely.
Okay.
Definitely ordinary.
I didn't know if
And it could happen. Definitely could happen.
Okay.
The inventory has an embedded loss. Taxpayer may have an ordinary loss on the inventory, for example, and a 741 capital gain. Definitely in the realm of possibilities.
Okay.
So for the step 3, 741, because it has one is capital gain, the other is capital loss, and these 2 items are at the same rate.
The 2 items what?
At the same rate, tax rate.
No, the collectibles at 28%, right? And the regular capital gains rate is 15 or 20%, depending on your income threshold. Okay? And
So it's not 0 yet. You will have to tax.
it doesn't eliminate. You would actually have these numbers appear, and it could have its own unique rippling effects. And question C, yes, a mess. Question C. Same as A, except the collectibles have a basis of 3,000 and fair market value of 1,000, right? So now it has an embedded loss rate of 2,000. Everyone see that? I have it written in the margins of my book, where the basis is 3, fair market value of 1, and the other capital assets have a basis of 4, fair market value of 4. So there's no gain or loss with the other assets. Everyone see that? We go through our same 3-step process in problem C. Step 1, gain or loss of how much?
Gain of 6.
6. Everyone agree? Same as A. 6 6,000, right? Step 2. Gain or loss?
Gain of 7.
Gain of 7. Everyone agree? Right, Betty? That's the receivables, right? And step 3,
1,000 loss.
1,000 capital loss. Step 3 is 1,000 capital loss. And the regulations, this is example 3 from the regulations. It's regulation 1.1H-1F, example 3, says just treat this as a long-term capital loss. Long-term capital loss. Okay? The regulation site is 1.1H-1F, example 3. Now look, guys, I don't want to get too bogged down with this. I want to care, or I do care, problem 1 and 2, prior pages. I like this problem. The only part I really like is step 1, 2, and 3, getting the numerical answers correct. I am not going to worry, you should not worry about different kinds of capital gain, okay? You'll cross that bridge if and when you come. Kelly?
I'm just quickly curious though, why would the 1K loss be long-term and not left?
If you read the regulation, I share your view. The regulation says that they're not going to give you a capital loss in this context. It's treated as a long-term capital loss. Look at example 3, see if you subscribe to it. It's just one person at the Treasury Department. All right? I'm sure there's oversight, there's more. I hear where you're coming from, but that's why don't look for this on the exam. Guys, time doesn't allow us. We got, like I said, I want to highlight important things that I want you to take out outside the classroom. So let me keep going here and highlighting those things. So I'm telling you, everyone here hopefully can do a problem 1, 2, and this problem, get the numbers of step 1, 2, and 3, okay? Everyone can do that? That's what I care about. Collateral issues. There's some holding period issues, right? Because remember Code Section 721 and Code Section 1223. We dealt with the first week of class. And that is your holding period taxed or not taxed when it comes to making capital contributions to a partnership? And remember, it depends. If you contribute capital assets or 1231 assets, there's a tax holding period, right? Tax holding period, whatever holding period you had, tax on. So if you held the capital asset long term and now you contribute it long term, but if you only held it for 2 months and you get back a partnership interest, you need to hold it for 2 months. If you contribute cash, inventory, accounts receivable, your holding period begins the next day after contribution, right? And remember, 721 can happen at any time during the life cycle of a partnership, agreed? So if you make subsequent contributions to a partnership, your holding period can, even though you've held your partnership for 10 years, and now you make an additional $30,000 cash contribution, and you get back a new partnership interest, that you can have a short-term interest if and when you were to sell that. Everyone agree? So the authors are trying to be sensitive to that with respect to holding period issues.
And that's if you actually get more percentage of the partnership.
That's if you get more. If you don't get more, not going to matter. Okay? So if everyone makes equal contributions, not going to matter.
Okay.
Then they talked about installment sales. Some of you know or are familiar with Code Section 453. Generally, you can not defer the receipt of taxable income with respect to sales of inventory or marketable securities and 1245 gain. Okay, let me repeat myself. Is that you can get installment treatment, okay, with respect to a lot of property, but certain properties are precluded from getting installment treatment. The other properties which are precluded from getting installment treatment are inventory, marketable securities, and recapture income. You cannot get installment treatment. So you can't defer. Even though the payments may be deferred, you are subject to tax immediately on your gains.
What are those three? Inventory, recapture income?
And recapture income. Okay. Inventory, marketable securities, and recapture income. Right? And, not surprisingly, the revenue rate rolling 89-108. And we're going to pull up your chair to find out that you sell a partnership interest. To the extent the property pertains to those items, you can't get the installment treatment. Okay? To the extent they pertain to those items. So look on page 305. The second full paragraph, under page 305, 7 or 8 lines down, on the very far right, it begins the word because. Because the installment method of reporting income would not be available on a sole proprietor sale of the inventory, the installment method is not available for reporting income realized in the sale of partnership interest to the extent attributable to inventory, which constitutes inventory within the meaning of Code Section 453 B2B. And then on the note that follows on page 306, a little further down, it goes on the first paragraph, 8 or 9 lines down towards the right. It says, this definition makes clear that 751 gain on the sale of a partnership interest that is attributable to depreciation recapture must be recognized in the year of sale. So that takes out recapture. The last paragraph talks about marketable securities and things like that. But let's look at the problem on page 307. Again, what I really care about is step 1, 2, and 3 on all these, okay, for the buyer. That's my, these things pertaining to holding period and installment sales are nice, but again, what I care about is step 1, 2, and 3. Okay, so we have a partner that is disregarding the application of 483 and 1274. What are the tax consequences to A? He sells his interest for $150 to be paid $50,000 per year over 3 years. Okay, so he's going to be paid $50,000 per year over 3 years. So first things first, everyone ready? Take 1 minute, keep my mouth shut. Give me numbers. You figure out the numbers for step 1, step 2, and step 3. Okay? Right. Andrew, Anthony, what do you guys have for step 1 and step 2 and step 3? Step 1, Andrew, you take the plate.
I'm not there yet. 112 would be the total amount.
Okay, how'd you get that?
It's not considering. It's 150 is his consideration and
amount realized. Let's call it amount realized.
Amount realized.
What's his basis?
38,000.
So gain of 112. Everyone have that numerically? Gain of 112. Step 1. 150 minus 38 for your notes. Vital, you got that?
Yeah.
Okay, 112. Anthony, step 2.
Step 2, there's 3,000 from the inventory.
What do you have, 3,000?
No, I have 33, but I have 3,000 from inventory and the other 30 from the furniture.
Go slowly. Tell me how you got your numbers. How much is embedded in the inventory?
So embedded in the inventory is a gain of 6.
And what size partner is this? He's a 1/3 partner.
Sorry.
So how much gain is attributable here? 2. Everyone agree? 2,000 of gain with respect to the inventory, right? Keep going. What about Anything else in step 2?
And 20 from the furniture.
Okay, why? It's a 1231 asset, it's all 1245 gain. Everyone agree? And even though this is being paid over 3 years, does any of this gain qualify for installment treatment? No. Everyone agree? And 2 plus 20 equals how much? 22. Amber, how much gain does that leave? 90, right? Now,
Oh, we got the 24 again.
what?
The 22.
It's 2,000 on the inventory, which is 1/3 of 6, plus 1/3 of 60, which is 20. Right? You good?
Okay.
You got it? And the third step is our 741 gain and 90. And that, good news, we can use code section 453 and pay it over 3 years, right? 30, 30, and 30. That does qualify for installment treatment. Right, Jenny?
The installments are always equal? Is it always just split equally?
It should be split equally. There should be a built-in interest rate here, but that's, the problem tells us to ignore it. All right, so that 30,000 under the installment treatment can be taken into income over 3 years. I'm sorry, Ashley?
Step 3, just 112 minus 22. And then
It's 112 minus 22. The balance is 741 gain.
Okay, and then what was the part about the installment?
Well, it's being paid over 3 years. So first we have to take 22,000 into income year 1, plus we have to have 30,000 in capital gain in year 1. And then we can take the other remaining 60,000 of $30,000 in year 2 and 30,000 in year 3.
So the capital gains can get installment.
Say again, Ashley?
So the capital gains can get installment.
Absolutely. Okay, so for my purposes, guys, for exam purposes, consequences to the selling partner. Everyone, my objective is, for exam purposes and outside the classroom, that you remember this 3-step process. That you never, the old cliche, don't forget the Alamo, don't forget code section 751, right? We're good? You can handle this, right? On the exam, there's not going to be anything harder than this. And again, I'm not going to look for different kind of capital gains rates or things like that. All right? All right, you ready to look at the consequences to the buying partner? So I'm going to get this, during the break, if anyone wants to take a, since a work of art, you want to take a picture of this, I will not erase it. But I will likely erase it after the break because we have a lot to cover. So, and I'll make a lot of board space. So be forewarned that if you want to make a copy during the break, do it. All right. Let's get our ducks lined up with various code sections and see where life takes us. So, first, we start off with code section 742. Add that to your repertoire of subchapter K code sections you should have a good handle on. Nothing complicated about that. The basis of an interest in a partnership acquired shall be determined under Part 2 of subchapter O. Really, it's your cost basis, right, guys? Akin to code section 1012. Okay. Now, if you look, just keep your finger. look at Code Section 722 and 723. We'll take a quick walk down memory lane. Code Section 722 talks about the basis of a contributing partner, right? It tells you what the partner's outside basis is, right? And what does it do on the next code section? It tells you what the basis is of the property that was contributed, right? Everyone see how it nicely fits together? 722 talks about outside basis, 723 talks about inside basis. Agreed? Outside first, inside next. Agreed? Now, Code Section 742 talks about outside basis, and Code Section 743 talks about inside basis, right? And 743A says, the basis of partnership property shall not be adjusted. Not be adjusted. Inside basis shall not be adjusted as a result of a transfer in interest in partnership by sale or exchange or in the death of a partner, unless essentially there's a 754 election in place. And let me just make an observation that generally, when you buy an interest in a corporation, you buy shares in a corporation, does the inside basis of what a corporation owns gets adjusted? The answer is yes or no? No, categorically not, okay? The basis generally of the entity, the assets the entity owns, does not get adjusted. Now, I will point out, and what we learned here is, however, if there's a so-called 754 election, there will be a basis adjustment. And the amount of the adjustment is determined under Code Section 743B. 743B. And that amount is then allocated pursuant to Code Section 755. So there's a whole cascading effect of code sections. So first you have, if there's a 754 election, if there's a 754 election, it triggers 743B, which talks about the adjustment. And then Code Section 755 talks about how that basis adjustment shall be allocated. I will point out, in the sphere of S corporations, there is an analog to 754 elections. It's called a Code Section 338 H10 election. Okay, some of you may have heard of that. So that when you buy an interest in an S corporation, if you buy an interest in a C corporation, there's never an adjustment. The inside basis always stays the same, period. And some people would argue Congress might or should consider doing away with 754 elections. You buy a partnership interest, so be it. No inside basis adjustment. But with pass-through entities, life gets more complicated, and as a break to small business, we had these 338 elections and Code Section 754 elections. By the way, some of you actually do partnership tax returns. Those who do, can I just see a show of hands? Anyone here deal with partnerships that have made 754 elections? Lisa, anyone else on this side? Jenny, you and Jenny, how many partnerships do you deal with? Just make up a number, approximately.
How many in 1 year? Or?
Yeah, 1 year. Is it 50 or 100, 200?
Between 30 to 50.
Let's just 30 to 50. And percentage-wise, how many have a 754 election in the town?
Not like every year, maybe like one.
Very few. And Dill? How many partnerships do you deal with, and how many have a 754 election?
Probably deal with a couple hundred every year.
Couple hundred?
Yeah.
Okay, and of the couple hundred, say 300, how many have a 754 eletion? 10. So
it's small
percentage. And Lisa, do you have a different percentage?
Not to allow production for a year, but we we do have like the carry for the 750.
Well, I mean, once you get a 754 election,
It's
you
there.
got it.
Yeah.
You don't get rid of it.
So there's
It's like a tattoo, okay? You're not going to get rid of it.
Yeah, so I think a lot of partnerships.
So a lot of your partnerships do.
Yeah.
The majority, at least I'm hearing you verbally.
Yeah, because they have the, I'm working on like in the real estate
So
industry.
it's real estate, and you're saying they do.
Yeah.
Dale says very few.
Well-
Jenny says few.
I mean, I deal with a big group of things, so there's a piece of properties that one partner owned that they ended up transferring out. They gifted a bunch of stuff out and whatnot. So that group that he got rid of.
Right, I'm just saying it can run the gamut. There's a lot of times smaller partnerships will never not make a 754 election. Some industries, everyone makes a 754 election. So it's something that I just want people to be aware of, that it's not one of those elections people always make or an election no one makes. It's really going to be specific, and if it's good for one person now, doesn't mean down the road it's going to be good for everyone. So you have to weigh considerations. A lot of considerations go into making whether or not to make a 754 election, okay? The only good news, or a good piece of news for everyone in this room, that if your client makes a 754 election, you should be charging double, okay? I'm not kidding you, because Lisa, much more complicated? Dale, more complicated?
Only the first year. After that.
Only the first year, I don't know if I agree. I mean, because every year there can be new adjustments. Well, Jenny, more complicated? More complicated. I mean, well, you'll see. You guys be your own judge. But my point is, if a client is considering it, you really owe it to yourself and to the client to say, hey, this may be good, may save you money. There may be a downside down the road that may be unavoidable because once maybe you can't get rid of it. But your accounting fees are apt to be more, okay? Meaning your professional fees are apt to be more. So you should at least tell the client in advance so they don't look like you're like, you should make the election, you should make the election. And then the week after they make the election, it says, hit them with a bill which shows them how much more work you've had to do as a result. So just be sensitive to that. As long as you tell clients up front, let them make the decision, and so be it. They may say, hey, it's worth it if I pay you more. Okay, so just something to be aware of. All right. So the notion again is that we have outside basis and inside basis. Everyone agree? And if this weren't a partnership, we'd almost be done tonight, right? Because we could just say, hey, the person bought an interest, they have a cost basis, and let's move forward, right? However, life is not so simple, okay? And we have Code Section 742 that discusses outside basis. 743 says no adjustment. If there's a 754 election, you got to make an inside. 743B tells you the adjustment, and 755 tells you how that adjustment is to be allocated. So that covers pages 307, 308, 309. Okay? So let me just emphasize this, that when there is a difference, normally again, if there's no 754 election, let me make some more observations. If there's no 754 election, guys, this is not complicated. What do I mean this is not complicated? Someone buys partnership interest, their outside basis will be whatever they pay, plus liabilities. Agreed? Nothing challenging. And Code Section 743A, their inside basis and their assets, it is what it is. Right? Everyone agree? Nothing complicated. And when they buy a partner's interest, their capital count should be whatever the capital count is of the partner whose interest they're buying, right? Because economically, their stake should be the same as the person they're buying out. Agreed? Agreed. So, what I don't want people to do is get overwhelmed. I want people to realize that I'm going to make up a number. I didn't do any studies on this. 90% of partnerships, I'm going to say the majority. I feel very comfortable saying this. The majority of partnerships do not have 754 elections, okay? And I'll even go to say, as far as saying 80-90% going to 754 elections, which means for you guys, if you have a partner or person, your client buying a partnership interest, many times this is a pretty easy exercise, okay? However, 10 or 15% of the time, there is either a 754 election already in effect, or if you don't mind me saying, there is no 754 election, but you better tell your client that he or she should consider getting the partnership to make a 754 election because economically it makes sense for them, and we'll go through the reason. So you can't just say, oh, this is great, there's no 754 election, this makes your life easy. Because your client, if they subsequently find out that they could have made a 754 election and you didn't tell them they could, that's grounds for malpractice, okay? Whether or not they could have gotten the partnership to make it is a different issue. But you don't want to leave yourself open for that exposure. So you must, whatever you're doing, in my opinion, with a buying partner, you must or should alert them about whether to consider. Now, they don't make it individual. It must be made at the partnership level, okay? But they might, and often I've seen malpractice cases say, had you told me, I would have negotiated that. Whether or not it's true is a different issue. Everyone can dream, right? But it's up to you to at least put them on notice still.
Is there a percentage threshold for like the transfer percentage that a 754 kick in, or is it any transfer?
No, I mean any transfer you can. Anytime a partnership can make a 754 election, there's no even triggering mechanism. They can make the 754 election at any point. Okay? So you really, in my opinion, have to add to your repertoire of code sections in partnerships. So 754 is a biggie. Not because it's universal, okay? Not because it's universal. But it's an option that always is out there. And even if it isn't utilized, it may be something your client says, and your clients in this day of the internet will find out about 754 elections. So even if they don't know about it today, down the road they'll learn about it. If you haven't told them about it, again, that can come to haunt you. Because many times 754 elections can lead to the biggest, what did 754 open the doors to? Higher inside basis leads to what? Higher depreciation deductions, right? Everyone agree? That if I am partners with Tamara, let me say Tamara and Annetta are partners, okay? And they own a building that they fully depreciate. The basis is zero and it's worth $1 million. Everyone have the visual? Tamara and Annetta are 50-50 partners, and they bought a building. They depreciated it down to zero, but it's still worth $1 million. And Solon wants to come in, right? And I'm going to buy Annetta's interest, right? I buy her interest. How am I going to pay? How much do you want, Annetta? $500,000, right?
A little bit more.
A little bit more? I'm not going to pay you more. All right? But I'll pay you $500,000. I promise you, okay? Here's my IOU, right? I pay her $500,000. Everyone get the visual? Does my inside basis to the partnership interest change? No. And guess what? Going forward, any depreciation deductions? Big goose egg, right? Everyone agree? 743, no basis adjustment. Agreed? However, if there was a 754 election, right, I would have a personal $500,000 basis in that building. That would be my adjustment. Okay? And I personally can get the depreciation deduction on that $500,000, and it's treated as if there's a new asset that partnership acquired. Okay? So we would start, if it was commercial real estate, a 39-year depreciation, right? And I'd be a happy camper because I get to depreciate $500,000, right? Now, granted, over the lifetime, by taking the depreciation, my outside basis will go down, right? Where, had I not gotten the depreciation, my outside basis wouldn't. So subsequently, I'm going to recognize more gain, but time value of money concepts. All right? So my point is, that's why, in my very simple example, Solid would have wanted to know about the 754 election, because, damn it, I wanted those depreciation deductions, and you didn't tell me? No, come on. Right?
How about the other fund? We'll have.
No, Tamara's, she's done. She doesn't get anything. She didn't, that's not, she doesn't, she cannot avail herself of the 754 election.
So is that only for only one partner?
Well, in that case, only one partner, is that 754 advantage inures to me.
So that's your outside basis. What happens to the inside basis?
The inside basis is, my outside basis is 500, and my inside basis is 500 in my example.
But how do you factor in the other fund?
It doesn't in this example.
Why do you disagree?
Because Tamara's going to end up possibly, because Kelly's going to be the accountant, she's going to charge more now to do the tax return. So we got to get Tamara to sign on board, because now the accounting fees are going to be higher. Okay, I'm just giving you a very simple illustration. So Tamara may not want to do it because, or she may say, listen, Solid, you're buying the interest, you pay the additional accounting fees, and sometimes that's done. Okay? Michelle?
So to take it a step further, so if you've got your general partner that makes all the decisions for all these 60 partners.
But you got to look at the operating agreement to see if that's delegated, that partner will decide whether or not to make a 754 election. But probably the majority of partners, depending on the voting rights, could remove the general partner. Right? So the general partner should check into before he or she willy-nilly just makes the election. All right? So again, buying partner, okay? Buying partner, vast majority of the time, very straightforward. Outside basis equal to what paid for. Inside basis doesn't change. The complications are with respect to a 754 election, okay?
It's on property basis, or it's like, say, if you're buying two properties, so you would do 754 election on one property?
No, it's not. It's for the whole partnership, and then there's an allocation. So you don't get to cherry pick which properties. And the 754 election, once it's in place, can come to haunt you, because if the property has precipitously declined in value, okay, you may have a lower basis than the other partners. Okay? So it's a two-way street. It does not always work out to the partnership's advantage or the partners. And once you have it there, it's like poison ivy. Very hard to get rid of. Ellie?
Does it only apply to new partners or also existing partners who buy more?
It applies once it's there, and now existing partners have their own implications if they make future contributions or they buy from someone else. Once it's there, it applies. It doesn't apply immediately to Tamara, but it can apply to her indirectly down the road. Right? But see, let's go through and look at the material, and you'll see it in action. So I just wanted to give you a general feel for this before digging deeper. Now, sometimes 754 is considered automatic if there's a substantial built-in loss. Okay, the authors go through. If there's built-in loss of more than $250,000, this is on page 309, that 754 becomes mandatory in that example, because otherwise taxpayers could game the system. Page 310 talks about how do we calculate the 743B adjustment. And there's this concept which is pretty funky, and get caffeinated during the break, because we're going to have to figure out what is previously taxed capital. Previously taxed capital. And essentially, previously taxed capital, okay, this is on the bottom of page 310. This is a key term to figure out what is the adjustment amount. And sometimes in simple situations, you're gonna eyeball it. Like in my example, I just gave you an eyeball it. We know it's 500,000. That the adjustment was 500,000. But it can get really funky if there's 704C gain, built-in gains or losses. It can get really funky. So what we'll see is it goes through and says, what happens, how much cash would the selling partner get, plus the tax loss minus the tax gain, equals the previously taxed capital. Let me repeat. You go through an exercise, and you see how much cash, if there is a disposition of all the partnership assets, how much cash would be received by the transferee, how much cash plus any tax loss minus any tax gain. I repeat, how much cash would the transferee receive plus tax loss minus tax gain will give us this PTC. How's that for a new acronym? PTC. And once we figure out that dollar amount, we turn the page to page 312. We're going to allocate it in accordance with Code Section 755. And essentially, we're going to bifurcate it, here's a surprise, into two classes of assets. Class 1 is capital assets and 1231 assets, and Class 2 is all other property. And on page 314, the authors talk about, just want to call to your attention, on page 314, the first full paragraph talks about that 754 elections have no effect on your capital accounts, zero effect on capital accounts. That's the takeaway. If you look next to footnote 74, it says, these basis adjustments do not affect the transferee's capital account. And in the next paragraph, the last sentence says, the amount of the adjustment is treated as being attributable to a newly purchased asset for depreciation or amortization purposes. So, like I said before, it's treated as if it were a new asset. And recall, Code Section 704C, make sure that partners cannot shed embedded gains and losses of property they contribute to a partnership, right? Code Section 704C puts the brakes on partners shedding pre-contribution gains and losses. And in the very last paragraph on page 315, second sentence, it says, Section 704C1C provides in the case of property that was contributed to a partnership with a built-in loss, no other partner, including someone purchasing it, may be allocated that pre-contribution loss. So, what I'd like to do is go through problem 1 and then we'll take a break. So let's see if we can get through problem 1. And then we'll take a break. So, our fact pattern is very simple, right? Our fact pattern says that during year first of year 1, your partner purchased a 1/3 interest for $40,000. At the time, the partnership had the following assets. If 754 had not been elected by the partnership, what is the result to new partner upon the collection of the receivables? Okay? So, what does this seem to indicate? Who would be taxed on the receivables? New partners outside basis is how much, guys? Not a trick question.
40,000.
40. What's our authority? What code section? 742. Everyone agree? 742. Any change to the inside basis? Stays the same, just like the song, right? What's our authority? 743A, right? So when the receivables are collected, who gets taxed in them? each of the partners gets their 1/3 share, right? Everybody agree? $10,000 apiece. He would be taxed on. He's not a happy camper, right? Because it's like, hey, I don't. The value of what I own didn't seem to go up, and I'm being taxed on $10,000. Everyone agree?
His outside basis.
But his outside basis goes up under what consideration? 705. Okay.
The right one.
It goes up 10,000. It goes up by 10,000. And by the way, this is true, right? When you buy into a corporation, right? And you buy a corporation, and then it makes a dividend distribution, but the earnings and profits were earned before you were a shareholder. You might also, say, gee, this seems more like a return of capital than income, but that's not how it plays out, okay? So for your notes, guys, the buyer here has an outside basis again. Of the purchase price, we said it was 40, right? The gain here would be 10,000 of ordinary income. Outside basis increases by $10,000 under Code Section 705, right? We're good?
How much inside this is?
Inside, when you say the inside basis doesn't change. Okay. Ready to problem B? What resulted in the partnership had made a 754 election. And so now we have to say this is 754 election. So we got to figure out what the 743B adjustment would be. Everyone agree? Everyone agree with me? You got to figure out that 743B adjustment. Now, on some problems you can eyeball it, okay? So be careful, because I'm going to tell you can eyeball it, but then other problems that eyeballing is going to get into danger. Okay? What's his outside basis? 40. What's his percentage interest in the inside basis?
83.43.
What's his percentage interest in the inside basis, guys? Number? 1/3 of how much? 60 or 20, right? Everyone agree? Like, the inside basis here, total 60 times 1/3 is 20, right? Now, again, we're going to get more sophisticated. I'm just going to give you like a general hint here. That it looks like this tentatively, right, Lisa? The adjustment here is $20,000, the 743B. Everyone eyeballing it and can see that? Adrian, you got that? Okay. But that's not technically what the code regulation says. It says we have to look at the difference between the outside and inside basis, and the transferee's share of the adjusted basis to the partnership of its assets is equal to the sum of the transferee's interest in the partner's previously taxed capital, PTC, the transferee's interest in, plus the transferee's share of the partnership liability. So let me repeat this, that for your notes, that his inside basis is equal to PTC plus his share of the partnership liabilities. Okay? And this is found in Regulation 743-1D1 and 2. I'll repeat. Regulation 743-1D1 and 2. How much cash would the transferee receive increased by the amount of tax loss, decreased by the amount of tax gain? I'll repeat. That regulation says how much cash would the transferee receive had everything been sold for fair market value, increased by the amount of tax loss, decreased by the amount of tax gain. if everything here had been sold, the accounts receivable and land, how much would our taxpayer receive, guys? Say it loudly. 40,000. Everyone agree? The cash, right? Everyone agree? Nothing complicated. Our taxpayer would have received 40,000, right? Because the receivables would have given rise to 30,000. The land would have given rise to 90,000, right? Is there any tax loss here? No. Is there any tax gain here? What's this pro rata share of tax gain? 20, right? Everyone agree? And there's no liabilities here. So PTC is equal to 20. And that's not going to surprise anyone. We eyeballed it and came up with that same number. Again, it's the amount of cash received, and in this case, minus the tax gain.
The tax gain.
Right? Everyone see that the taxable gain here on the receivables is 30, on the land is 30, 30 plus 30 is 60, 1/3 of that is 20. Now, we figured out the 743P adjustment, right? Now we got to figure out the code section 755 allocation, right? Everyone agree? We have to allocate it between the accounts receivable and the land. In code section 755, both of these properties appreciated, right, by 30,000. That's the embedded gain. We have to divide it between the capital asset and the inventory. Here, each had appreciated equally, so that $20,000 adjustment will be divided 10 and 10, and the adjustment here will be 10 and 10. The adjustment will be 10 to each. 10,000 to the receivables, 10,000 to the land. Which makes sense because now if the receivables are collected, would our taxpayer have any income? No. So your answer, question B, is there would be a $20,000 adjustment, 10,000 allocable to the land, $10,000 allocable to the receivables. $754 allows the equivalent of a straight pass-through, right? Opens the door to that. Question C. Who makes the 754 election? Like we said, the partnership makes the election. If you go to regulation 754-1B, 754-1B sets forth the rules. It has to be made on the timely filed tax return, things like that. Dale?
The reason N gets no income is essentially it's like, sorry, not N, new partner. That 10,000 that went to AR, it's like another expense that goes to N?
Yeah.
In that current year, okay.
Can we go back to B for a second?
Yeah.
Please? So we said the inside basis share was 20K. So that was the adjustment, and then our
that's the adjustment, and then 755 you have to allocate it to both pieces of property.
So PTC and that adjustment is the same number. It's by accident, or that's how it should be all the time?
Yeah, plus the amount of liabilities will be the adjustment. You'll see. Hold that thought. You'll see it on Mark.
But then are you saying that then that 20,000 is reallocated, so the new adjusted basis for accounts receivables 10,000?
It's
the new adjusted basis?
It is, but only to this partner. So it's not like the other partners share that. Okay, so it's not a universal. It's only to this partner, the purchasing partner. Question D, should the new partner condition his purchase of the partnership interest upon a 754 election? It depends on how big the stakes are, right? Because, again, we're going to see, 754 is not always a good thing for partners, okay? So you may condition it, but the partnership may fall. Will new partners purchase it and the 754 election have any immediate effect on the remaining old partners? And we said, what, guys? Yes or no? No. But we'll see when we start talking about distributions. When if there's a 754 election, there's something. You know how we just did 743B? Okay. You can try out your dyslexia because there's going to be a possibility if there's a 754 election, 734B adjustment with respect to distribution. So the 4 and the 3 are going to be reversed. But we'll deal with that with distributions, okay? One step at a time. The answer here is no immediate effect. Question F. Will the basis adjustment affect new partner in situations other than the collection of partnership income, the sales of property? Okay. And it says, will it have any other effect? And we just said, on distributions it will have effect, and depreciation deductions will have effect, and, well, those are the two biggies. Depreciation deductions and subsequent distributions.
But this one's on land, so there's no depreciation involved, right?
Yeah, on the land there's no depreciation.
Okay.
But it could easily have been a building too.
Right, but I mean, this is no problem.
G, at the end of year 3, the partnership had earnings, all of which have been distributed, and continue to hold the identical accounts receivable and land, each of which had the same basis and fair market value. It says, assuming, I circled the word no, assuming no 754 election or result to new partner, if before the receivables are collected, he sells his partnership interest to buyer for $40,000. So he sells his interest to buyer for $40,000, right? Let's go through. Now he's the buyer. He's the seller, not the buyer. Everyone agree? Everyone ready to do our pirouette or pas de trois? Right? We're going to do our 3-step here, right? What's the amount realized? 40. What's his basis? 40. Everyone agree? Step 1 is 40 minus 40, right? Any 751 gain here? Any 751 gain? 10, right? Everyone agree? 10,000 is 751 gain. What does that mean about step 3? Loss of how much? Ordinary income, long-term capital loss. Who would have known, right? There's a surprise, right? You didn't think Wednesday night could pack such a surprise, right? There you go.
So is this calculation pertain to...
All right, say it again, say it loud.
This calculation pertain to A or B?
No, it's the new partner.
When he elect the 754?
There's no 754 election here. There's no 754 election here.
So he's back assuming A.
Now, in question H, it said, suppose the new partner had made a 754 election. If the partner had made a 754 election, would step 1 still be 0? Step 2? 0. Step 3? 0. Right, Diana? Can change the outcome. Step 1, step 2, step 3, 3 zeros. If there had been a 754 election.
Why is 2 0?
Oh, what?
Because we have a collectivity of AR. Why is 2 0?
Because there was a 754 election, his basis in the receivables was 10,000. So there's no gain, there's no 751 gain to him. Because there was a 754 election. Question I. In question H, what is buyer's inside basis? What is buyer's outside basis, guys? 40, right? Everyone agree? And just, we're going to keep it simple here, is that we would have the same $20,000 adjustment, same fact pattern. You would have a $20,000 adjustment under Code Section 743B.
So how much is inside basis?
It's going to equal his outside basis of 40. I mean, that's the whole job. That's the whole purpose of the 754 election. So you would add 10 for the receivables and 10 for the land. So his basis and the receivables is 10, basis in the land is 30.
And that's because the 754 election was made previously, so the new partner gets stuck with it also, right?
The new partner, I don't know, in this case, the new partner isn't getting stuck. I mean, that's advantageous to the new partner.
Well, yes, but I mean...
Yeah. Question J. If the partnership properly maintained capital accounts and the selling partner's capital account prior to the sale was $20,000, what is new partner's capital account upon the purchase of his 1/3 interest for $40,000? The 754 election is in effect if it weren't in effect. In other words, the authors are asking, does the 754 election change the outcome? Okay? What do these regulatory sites say? Does it change this capital account at all? No, the capital account stays at $20,000. There's no change in the capital account. And finally it says, if the 754 election is in effect, will each new purchasing partner create havoc for a partnership's accountant? Oh, you guys have to answer that question. That's the author's way of saying it can be pretty challenging, okay? Why don't we do this, guys? We'll start up 8 o'clock sharp. So, again, in the absence of the 754 election, everything here is pretty straightforward, right? Outside basis, inside basis, no issue. 754, though, creates a triggering event, a 743B, Code Section 755, okay? And now it's going to get more complicated. So let's look at question 2 and 3. This is on page 316. ABC Cash Method General Partnership has made a 754 election and has the following balance sheet. At the time, D purchased T's interest for $60,000. None of the partnership interests were contributed by a partner. In other words, there's no 704C gain, okay? That's why the authors spilled some toner there, right? Notice there's some liabilities here, okay? Don't forget the liabilities in your computation. D purchased again C's interest for $60,000 cash. Now we're not looking at the effects to C. Okay, that's not what we're looking at. All right, that would be our 3-step process. We need D's. There's a 754 election. We need to figure out what is the 743B adjustment, right? And then we need to know how to allocate under 755. So everyone come up with a number, okay? Take a minute. Now knowing what you know, try to come up with a number. Tendency exam. Come up with the internal basis adjustment. All right, the 743B adjustment. We're going to take the outside basis. What's the outside basis here? 70. Everyone agree? Everyone agree the outside basis is 70, right? And then we're going to subtract PTC plus liabilities. And we're going to subtract that. And that will give us our 743B, the PTC plus liabilities. What's the previously taxed capital? How much would the transferee partner, had this partnership been liquidated, how much cash would they receive? How much?
70.
Not really, right? Because they would receive 210 less liabilities of 30. The actual cash is 180 divided by 3 for 60. Okay? So had this gone through a liquidation, right? The numbers here would be 60,000. Where do we get the 60 again? There's 210,000 of assets. There's 30,000 of liabilities, right? That leaves 180 divided by 3. Okay? So there's 60,000 on liquidation. We have to increase that number by the amount of tax loss, right? Their pro rata share of tax loss. How much is their tax loss here on the assets?
5,000.
5,000, right? So you increase it by the tax loss, 60 plus 5, and then you subtract what? The gain. Their pro rata share gain, right? How much is the gain here to this partner of their pro rata share? 45.
How do we get the 5 again?
The 5 is the tax loss. Their share of the tax loss. You add the tax loss, you subtract the tax gain. So, what does this equal? 20. Plus the liabilities. What's his share of the liabilities? 10. The 743B adjustment is $40,000. How are we going to allocate that $40,000 adjustment? What code section comes into play? 755, right? Everyone agree? Peanut butter jelly, right? Of course, you got that? Yes? No? Maybe? What are you shaking your head about? Which number don't you get? I'm sorry?
Can you work through the 5 and the minus 45? Just the. Is that the, so the 5 is the inventory loss, right?
The 5 is, where do you see inventory having loss here?
I'm sorry, no, the land loss.
Yes, the land has a $5,000 loss.
And then the remainder gain is 45 when you times it by his percentage. The remainder of the assets.
Yeah, the remaining of the assets, his pro rata share is 45.
Okay.
Doris, you got that?
No, I got the 5 as the right one.
Okay. So that's our 743B adjustment. Now we have to allocate it. Right? You got that? Now we got to allocate it, right? So we got to allocate it in accordance with code section 755. And how much 1231 capital asset gain do we have here? What's his pro rata share? The land in the building, guys? 20, right? Everyone see that? In the land in the building, there's a $15,000 loss in the land, and there's a $75,000 gain in the building. Put those together, right? That's 60,000 divided by 3. There's a $20,000 gain, right, Amber?
I'm sorry, I was still on the first problem. I was just finishing my question.
Okay. All I'm pointing out is we have to divide. Now, if you agree with me that the adjustment is 40,000, now we have to divide this between the capital assets, right, and the non-capital assets. And when I say capital assets include 1231 assets. And it's $20,000 of gain attributable to the 1231 capital assets, and the non-capital assets, 20,000 also. Everyone see that? that there's 60,000 in built-in gain on the inventory and receivables divided by 30, so it's 20 each. So that means we're going to divide this $40,000 adjustment evenly between the non-capital and the 1231 and capital assets. And we have inventory, accounts receivable, land, building. His share, D's share of the inside basis is 0, 10, 10, 10. Everyone agree? And initially, his basis internally in each is 10, right? And then we have his own personal adjustment, okay?
Oh, okay, that's the original basis. Okay.
That's the original basis.
I was like, why is it still 0? What the hell? Okay.
Okay, plus 10, plus 10, minus 5, plus 25. And this should equal 40. And you will then have a basis of 10, basis of 20, basis of 5, basis of 35. And this 25 we treat as a new asset. We'll start getting subject to new depreciation. So his inside and outside basis is now both 70. Everyone good?
No, I had the same 743 adjustment. My result was same, but my process was a little different. So what I did was I said 60,000 was the cash that was involved, that buyer sold. So then I said there was no loss, and I said there was 40,000 gain from totals.
I mean, you may come up with the right number, but unless you do this formula, Mar, I can
So I
just
took
say.
it from the totals. Would it give me different results at different times? That's what I'm not sure.
Call me mechanical. Just go through this formula. You'll get to the right adjustment. You veer off this formula, I can't tell you. Another.
Explain one more time. How did you get 10, 25, and no? We go back. How did you put 10, 10, 5, and 25 adjustments? How did you distribute that?
Because Code Section 755 say do it in proportion to the appreciation of the property. Okay? And here we have, and it makes sense. Okay? This makes sense.
Thank you.
All right, but the more we do, the more proficient we become. So get this in your notes. You'll review it this weekend. If you don't get it, you'll shoot me an email. Hopefully you get it. Again, by looking at, given it's daylight savings time, it even feels later to your body on a Wednesday night. All right? Now, question B. What is D's personal inside basis of the assets? And the assets if he had paid $70,000 rather than $60,000. Okay? Now, what's the difference here? What are the authors driving at? Suppose he had paid $80,000 here. What are the authors driving at? There's another component here. What is he paying for? Why would he pay $80,000 when there's only his pro rata share looks like it's $70,000? No goodwill, right? All of a sudden there's some component here of goodwill. Everyone agree? That's probably worth $30,000, and to get his 1/3 share of it, he's paying an additional $10,000. Agree? All right. So let's do our same exercise, guys. Let's figure out what is his, just like we did before. What's his outside basis? 80. Not a trick question. 80. And I'll keep my mouth shut for a minute. Figure out his previously taxed capital. All right. How much would we get previously taxed capital plus liabilities? Let's start. How much would we get cash? partnership had been liquidated?
220.
How much? Louis, you're gonna
80 and then it'll be 60 for him.
would he get 60 or would he get 70 because now there's goodwill, right? Let's not ignore the intangible, right? There's now, the partnership has another asset apparently worth 30,000. Everyone agree? In the form of goodwill. It's not on the balance sheet in your book, but
prorated up?
it should be.
Okay.
The point is, if you want on this problem, now there's goodwill worth 30,000. Everyone agree? With a zero basis. So if the partnership were liquidated, you get 70,000, right? Cash.
Are we on problem B?
So again,
Are
Ashley,
we on B or C?
we're at a B.
Throwing me off down there.
Come on down, Ashley. There's plenty of room here. You can't see. All right. So he's paid 78,000 rather than 60,000 because apparently there's goodwill. And had the partnership liquidated now, he gets $70,000 of cash. Okay. Now we have to add 5, right? Because that's the potential tax loss. Everybody agree? And we have to subtract the potential gain, right? Here we subtracted 45, but now we're going to subtract 55. Why 55? Because now the goodwill has an additional 10,000 of embedded gain. Everyone agree? So, what's our adjustment here? 20. And what are we going to subtract? It's a 20 plus the liability, or 30. Right? It's previously taxed capital plus the liability, so our adjustment is 50. So we're going to have the receivables, the inventory, the land, the building, the goodwill, right? And we're going to have D's share of it, and then we're going to have the adjustment. And D's share is 0, 10, 10, 10, 0. And then we have a $50,000 adjustment, right? And here the adjustment, 40% is attributable to non-capital assets, 60% is attributable to the capital assets and 1231 assets. Amber.
Where'd you get the 80? I thought it was 70.
Where did I get the what?
The 80. Wouldn't be.
His outside basis is 70 plus the $10,000 worth of liabilities, he's assuming.
Oh, I'm looking at pieces. Okay.
Okay?
And the 30 is the 20 plus 10.
All right, the 30 is the 20 plus the 10 of the liabilities. And the adjustment here is 10 and 10. This represents 40% of the adjustment. And then we subtract 5. These are plus. We subtract 5 here. We add 25. We add 10. And our new adjustment here is 10, 20, 5, 35, 10. Guess what? It's going to equal 80. And that's probably what you would have expected. Do you have a question?
Yeah, I kind of did it, but I'm confused. The goodwill, you said goodwill, there's 30,000, so that assumes the other partners contributed?
They didn't contribute anything. But remember, he's buying from an existing partnership, right? And he's buying a 1/3 interest. And he's willing to pay $10,000 more than the assets that exist on the books. So implicit in that, there must be 30,000 in goodwill.
Okay.
Right? Uh-oh, Apple.
up top, that initial calculation, is there any time that the liabilities you add to your outside basis are not going to be the same as the liabilities you add to your previous tax capital? It just seems silly to me to add it up here and add it down there, and it's just.
I got to think about this, Bill. I don't know, but just go through the mechanics. I'm trying to be mechanical, but that's.
No, that's fine.
Oh yeah. All right. Again, guys, this is just one more illustration of this. Again, many times you can eyeball it. The goal line is simple. When a partner buys an interest, and there's a 754 election, the inside and outside basis should equal one another, right? I'll repeat. When a partner buys a partnership interest, if there's no 754 election, don't look for symmetry. Everyone agree? But if there is a 754 election, the outcome should be the outside basis and the inside basis should be the same. Question C. Same as A, except that D buys C's interest for $60,000, except that C contributed the accounts receivable to the partnership at a time when the fair market value of the receivables was $30,000 and the basis was zero. Everybody see what happens? C has an embedded $30,000 what kind of gain? Built-in 704C gain. Everyone agree? So figure out what the adjustment should be here. That's the key here. What's our outside basis, guys? 70. Everyone agree? 70. What's our previously taxed capital? This is tough. Don't just jump to an answer. Previously taxed capital. What's our starting point? How much cash would we get if this partnership had been liquidated? How much? If the partnership were liquidated. How much cash would we receive? Don't look at the tax consequence. Look at the economic number.
Entirely, or?
Oh, how much cash would we receive? The partner who bought in, the new partner who bought in. 60, right? There is 210,000, 30,000 liabilities. There'd be 180, 1/3 partner, 60. Everyone agree?
Okay.
60. Okay? Do we add the tax loss? Any tax loss here? Yes. How much? 5. Now we subtract taxable gain. 65. Why do you say? Everyone hear that? 65. Why 65? Do you hear that? That the gain here would be 65, and that's comprised of which numbers here, Eric?
30 for the accounts receivable.
Everyone agree? That the accounts receivable, now we're stepping into that taxpayer's shoes, right? That 704C gain is attributable to, would be saddled to that taxpayer. So it's 30,000 704C gain. Keep going.
10 on the inventory.
10 on the inventory.
20 on the.
25 on the building.
Sorry.
So what does that add up to? 0. Plus the liabilities. So what's our adjustment? The adjustment is, well, ultimately the 743B adjustment is 60. Okay? Again, the tough part here is the previously taxed capital, and Eric correctly pointed out you got to add 30 here because our taxpayer is responsible for picking up all 30.
I don't get that 25 sales.
This one? Isn't that the gain on the building? It's 1/3 of 75. Okay?
And C's not skipping out on any gain because his outside basis was lower initially when he contributed, right?
C is not getting away with anything here because C, the selling taxpayer, is going to be saddled with a big 751 gain of ordinary income.
Right, okay.
Okay, C is not skipping out of town.
Got it.
Just for your notes, and then we got to finish up here. I'll just give you the adjustments. Okay, under Code Section 755, the receivables, inventory, land, building. This 60,000, right? Is going to be allocated the adjustments. 30, 10, minus 5. These are the adjustments. 25. So, for example, when the receivables do come in, if there's a 754 election, right? Normally we would have income of 30, but the new partner is not going to have any income. And that's the way 754 is supposed to operate. Protect. That's why it's pivotal you warn your client to consider, if possible, maybe to make a 754 election. But again, it's not always advantageous. Okay? So for your notes, this is the adjustment amount. These are just the adjustments. Okay? And of course they add up to 60. All right, third question, final question, because we got to get into the next chapter. We have a 3-person cash method partnership. Does not make a 754 election. Phew, right? Good luck, right? Much easier, right? You think? And a balance sheet. At a time where G purchased these interests for $50,000, right? That makes sense, right? The assets are worth, 150. You're going to buy it for $50. Economically, that makes sense. Everyone agree? D contributed the inventory to the partnership at a time when its value, the inventory was value of the inventory was $15,000. G's going to purchase D's interest, but D had contributed the inventory at a time, and remember, the basis was the same at 30, so he contributed when it had a built-in loss of 15. Everyone agree? Everyone agree? The inventory had a built-in loss of 15, and now it went down by another $5,000 in the hands of the partnership. Everyone see that? Any questions to raise? Well, the basis of the partnership has to be adjusted under 743 as a result of D sale to G. And the answer is, any adjustment here? If there's no 754 election? No. And keep in mind, look at the partnership assets, the balance sheet. The fair market value is 150, the adjusted basis is 350. Everyone see that? The partnership, this has not been the most profitable partnership. Everyone agree? A lot of built-in losses here. Agreed? Having said that, the losses here potentially total how much? 200,000. Everyone agree?
Yeah.
Keep in mind, if the losses, I better be careful when I say the numerical amount, is that if the losses are $250,000, you're forced into a 754 election, okay? If the losses, if you look on page 309, if it exceeds $250,000, okay, you must make a basis adjustment. This is so that people can't buy into partnerships and get massive deductions, that they are forced to reduce their personal basis in assets. So in response to question 3A, there is no adjustment, okay? And there's no personal basis as to G. No personal basis reduction as to G. Okay, so it just takes this, whatever you bought the asset for, that's the outside basis, and the inside basis stays the same. And question B says, assuming no adjustments were made to the basis, what will be the result to G if the partnership sells the inventory for $10,000? They suppose it sells for $10,000. Now let me just make some observation here. G steps into D's shoes. I'll repeat. G is going to step into D's shoes. That's spelled out in regulation 704-3A7. I'll repeat. 704-3A7. G steps into D's shoes. Except, code section, as I pointed out before break, 704C1C, code section 704C1C, prohibits the allocation of pre-contribution losses to any partner, aside from the contributing partner. I'll repeat, 704C1, capital letter C, says that lost property is contributed to the partnership. Only that partner, the contributing partner, can get that loss. No other partner can get the loss. That being the case, the deemed basis here of the asset will not be $30,000. Okay? The deemed basis will not be $30,000. Instead, the deemed basis will be $15,000. And what loss would be allowable here? The loss allowable will only be $5,000. That's the loss that occurred in the hands of the partnership. So only a $5,000 loss will be allowable here.
But that's split amongst everybody.
That's split amongst everyone, $1,666 to each partner. Okay, so each partner would get a $1,666 loss. What happens if the partnership sells the land for $90,000? How much of a loss will that produce? $180,000, right? How will that loss be split? Evenly between and among the partners for $60,000 apiece. Had a 754 election been in effect, right? There would have been a basis adjustment to our partner downwards, right? Our partner's personal basis, right, in that asset would not have been $90,000. It would only have been $30,000. Everyone agree? So I'm just making the observation that when there's lost property, a 754 election counts against the taxpayer, works against the taxpayer. Here there is no 754 election, so they can each get their pro rata share of the loss.
You gotta try real hard to have your land go down that far.
Just find some contamination. Come down. All right, guys, what's your takeaway from this chapter? When you have, for the exam, or a client comes in and you're representing a buyer, or I should say the other way around. When you're representing a seller, you're going to have to go through a 3-step process, figure out the overall gain, figure out the kinked, the 751 assets, whatever is left, 741 gain, okay? Everyone can handle that. 3-step, that's half the chapter. You can handle that, you're good for half the chapter. Second half of the chapter deals with the consequences to the buyer. the vast majority of the time it's pretty straightforward. The outside basis is whatever he or she paid for it, plus liabilities, right? Complements the grain decision. And the inside basis doesn't change. My authority, 743A. If, however, there's a 754 election, or alternatively, your client says, anything else I should consider, and you're going to say yes, you may want to try to negotiate a 754 election, and you'll have to figure out the 743B adjustment, and then make allocations in accordance with Code Section 755. I would, for exam purposes, keep it really simple, but you should be able to go through that multi-step process. Okay? And this weekend, before going forward, look backwards, make sure you have a good command of this. Go ahead.
I guess I was just wondering, so when you take that 754 election and then, you know your inside basis and your outside basis is going to be the same, why do you have to go through the 755? What cares?
Well, what you have to do with the 755 is really figure out internally, the inside basis will equal this, but you do have to allocate the basis appropriately, because it creates new assets for depreciation purposes and the like, Michelle. So it's an important exercise. All right? All right. Now.
So once you elect the 755, it's going to be always 755.
Once 755, Jay, what's your question? What?
Once 755 is elected.
No, 754 is elected.
754 is elected.
Right.
And even in the future, have new partner coming to this partnership, this 754 stays there, right?
Absolutely. 754 is not made by transaction. Once you have a 754 election, it's virtually impossible to get rid of, okay? So just be forewarned. Sometimes it will be advantageous, and when we go through some of this, you'll see it could be disadvantageous. All right, operating distributions. Operating distributions, chapter 10. Now, generally, with respect to operating distributions, what do we know? Red carpet treatment, right? When people form partnerships, right? Or their subsequent contributions, right? And I have evidence for that, Code Section 721, 22, 723, and the like, right? Everyone agree? And now we have a whole new repertoire of code sections because Congress, if possible, unlike corporations, right? You guys may recall, in the corporate sphere, there's two code sections that say if you distribute property out of a corporation during its lifespan, taxable or not, gain or loss. And what code section? In the corporate area. I know what you're holding back because it's Wednesday night. Code section 311, gain recognized, loss disallowed, right? Biggie in subchapter C. And that also pertains to subchapter S. In other words, anytime you make a distribution out of a corporation, whether it be a C corporation or an S, Code Section 311 dictates gain recognized, loss disallowed. Similarly, when a corporation is liquidated, Code Section 336, gain recognized, loss, gains and losses, by the way, can be recognized on a corporate liquidation. There's some limitations on losses, but they're generally allowed. 336D puts some brakes on corporate losses on liquidations. What is it with respect to partnerships? Any gain or loss recognized in the partnership on distribution? No. No gain or loss. My authority, Code Section 731. What basis will the partner take in the property being distributed? Generally, not always, whatever basis the partnership has. What's my authority? Code Section 732. So if the partnership has a low basis in the asset, say it distributes to me a building with a zero basis, fair market value of 100, I'll just take over the basis the partnership had. And finally, what will be my outside basis? So we're going to look at, when it comes to distributions, we're going to look at what is the basis of the property I received, and what do you think it does to my outside basis? Reduces it, right? Code section 733. Okay? Everyone get the general framework. Generally, it's pretty taxpayer friendly. Okay? Much more friendly than the corporate tax sphere, right? The corporations, there's a tax toll charge every which way you turn. The same is not true with respect to partnerships. All right, so let's take a look at this. Beginning on page 321, first the authors give us a little bit of an introduction in the first 2 pages. They point out there's sort of an anti-abuse provision, but we'll get to those later. We're going to reduce capital accounts, by the way, right? You get a distribution out, right, of a partnership that reflects a reduction of your economic stake in the partnership. Agreed? Yes, sir. So the consequences to the distributing partner, if you distribute cash, let's start with cash. If you get a distribution of cash in excess of your basis, you will have a gain. So you might as well just open up to code section 731. Generally, 731 says gain shall not be recognized as such partner, except to the extent the money distributed exceeds the adjusted basis. And losses generally aren't recognized except if it's a liquidation. And we'll get into that soon enough when we talk about liquidations. And if you look at 731B, the partnership has no gain or loss. And I just wanted to call out to your attention 731C. This is a relatively new code section that says treat marketable securities as if they're cash, right? Marketable securities, right, are pretty similar to cash. Everyone agree? If they're marketable securities, if instead of getting $100,000 in cash, you get $100,000 worth of Facebook, right? Isn't that pretty, easy to make it into cash? Pretty liquid. Thank you. So we're going to see how that comes into effect. 732, if you just talks about basis of the distributed property. And 733 talks about basis of the distributee's interest. That's the outside tax basis. Cash is one thing, but many times a partnership, and again, guys, we were talking about operating distributions. Next week, the week after, we'll be talking about liquidating distributions. We're simply talking about operating distributions here, okay? Different code sections come into play with respect to liquidating distributions. Okay, so operating distribution, sometimes not cash is distributed, sometimes property is distributed, right? What is the general psychology of property distributions? Generally, tax-free, and whatever basis the partnership has will be the basis you take as that partner. So let me give you an example. You have a $100,000 outside basis. Use your imagination, guys. Each one of you are a partner in the X partnership, okay? Each one of us in this room, you have an outside basis of $100,000, okay? And the partnership has a 75-story condominium unit, and each one of you is going to get 1 unit of this condominium, right? And in my first example, I'm going to keep it relatively easy. That the basis in the condominium unit is 25, and its fair market value is 200. Everyone have the visual? So you'll get this property, and what will be your basis individually in each condo unit? Because we have 75 people, we have 75 units. I'm going to make a distribution on the GP here. Your basis will be what? 25, right? Everyone agree? Will be carryover basis. And your outside basis will go down by what? The fair market value or the adjusted basis of the property being distributed? The adjusted basis of the property being distributed, okay? So, makes sense, right? Nice symmetrical outcome. However, in my example, how much did I say the condo unit was worth?
200.
200, okay? Let's say it's still worth 200, but this time, the basis is 125, okay? Everyone have the visual? The basis is 125, and your basis is 100. It's worth 200. What happens when you take it out? It's capped, meaning you can't get $125 basis. Your basis would be capped at $100,000, whatever your outside basis is, okay?
Can you say it again? Sorry.
Daylight savings time, right?
A little bit.
Okay. Is that if your outside basis is 100, right?
Okay.
And the distributed property has a basis of 125 in the hands of the partnership, your basis is limited in that property to your outside basis.
Oh, okay.
Okay?
Is you not allowed to have a negative?
You know, no negative basis in this world.
Is that just because you can't reduce your basis by?
You can't reduce it below zero under Code Section 733, and under 732, that's the basis you take in the property, can't exceed your outside basis.
And how about the inside basis?
You don't have any inside basis. You're getting the property distributed out. The property, there is no inside basis anymore to distributed property. It's coming out. Okay? So, you guys, you know how we talked about putting property in? Now it's coming out to you as a partner, and there's no concept anymore of inside basis. Okay? You have a basis in the property itself, not an inside basis. You own the frickin' property, right?
No, I mean, for example, if you have outside basis of 100 and inside basis of 100, and you get that property for 125.
No, the basis of the property is 120.
Yes. So your outside basis becomes zero.
Your outside basis becomes zero, and your basis becomes in the property itself the 100 cap. We'll see. It may have rippling effects under 734B, but that's an issue for a different day for the moment. Okay, Michelle?
You said the partnership basis and the partner's basis is the same? The outside basis?
I don't know what you mean by that, Michelle. In other words, we said in this class that your outside basis, Michelle, you invested in this partnership is $100,000, and now you're going to get a condominium unit as part of the distribution, right? And it's worth $200,000. You're happy. It's worth $200,000. And in the hands of the partnership, the basis, adjusted basis, is $125. When it's distributed out to you, your basis is capped. You're going to own that condo unit at 100. Your basis will be $100,000. If you sell it tomorrow, your gain will be $100,000. Okay?
So lose that 25. Got it.
You're going to lose that 25.
Okay. It just shifts the gain over when the person sells it. Yeah.
Okay? Now, I'm going to point out to you on page 323, there's one of the harder exercises here. One of the harder exercises is to figure out what your basis is in the property being distributed to you, okay? 732C offers a fairly complex set of rules, but be forewarned, it makes for good multiple choice questions, okay? Simply my question to you would be, what is the partner's basis in the distributed property, right? And you will need to know Code Section 732, because is that the kind of question that would come up in practice? Absolutely, right? People want to know what basis they have in distributed property, right? So this is not a curveball on my part. This is what would come up in practice, all right? And the authors give you, beginning on page 323, things to consider of how to make that computation, okay? The authors point out sometimes even if there's no 754 election, and we'll see in one of the problems, 732D on page 324 permits a partner to treat the distributed property as if a 754 election had been put into effect, okay? Again, we'll go through a problem that illustrates this, and at 8:55 on daylight savings time, it may be hard to absorb, but just make a mental note. I said on page 325, marketable securities is treated as the equivalent of cash. Remember, when distributions are made, if there's any debt on the property, relief from a debt constitutes what? Constitute a distribution, right? Relief on debt constitutes a distribution. If you look at revenue ruling 94-4, it talks about the timing, and it's treated, when that distribution is made, is treated as if made, at the end of the year. It's not treated as if made the moment it happens. It's treated as an advance. An advance is generally not taxable. And at the end of the year, let's see where the chips fall. So revenue ruling 94-4, simple proposition. If there's a liability adjustment, treat it as if it truly happens at the very last day of the partnership year. There's a revenue ruling 79-205. This is not a hard revenue ruling to read. I know there's a lot of numbers, and this is a new edition, guys. In the margins of my book, I have to tell you, if you want to follow any of these revenue rulings, I have here, I've written here, just because you can't follow it if you don't, in my opinion. I wrote A and B, what their adjusted basis is in the property, and then I wrote what their adjusted basis, their outside basis is, and then I wrote the inside basis and the amount of liabilities. So, if you don't mind me saying, you cannot, I mean, maybe you cannot, it's beyond me to do it. You can't read this and just, read it along. I think you got to be a proactive reader and actually write down the numbers on the side, or else, you need a little bit of a roadmap, okay? But again, you could be well beyond me, but I recommend that you consider putting the numbers in. So, let me just tell you, on page 331, I'm just going to do this. Give me 2 minutes to do this. I just want to do one simple problem just to illustrate. No, we're not going to do the whole problem. Don't get mad at me. All right? Listen to me. We have, in problem A, I just want to show you what one quick tax consequence, because it will set the tone. You have 3 partners here, right? And they each, we're each going to get a $10,000 cash distribution and land with a value of $10,000 and a basis of $5,000, okay? And they each have different outside bases, right? A, B, and C have outside bases of $20,000, $10,000, and $5,000. And if taxpayer A has an outside basis, right, of $20,000, and they get a distribution of $10,000 of cash and land with a basis of $5,000, fair market value of $10,000. Under 731A, no gain. Just write this down, and then again, this is going to apply throughout all this problem set. Taxpayer A, no gain. Code section 733. He's going to have a basis reduction here of how much? 15, right? It will go from 20 minus 10 minus 5. His outside basis will be reduced to $5,000. What's his basis going to be in the land, guys? And by the way, the authority for that prior one, Code Section 733, outside basis of $5,000. What's his basis in the land? $5,000. It's going to be $5,000. Okay, what's my authority? Code Section 732A1. Right? He's going to take it over. So you need to do that in each one of these problems. All right. So for next class, I'm going to review from the very start of this chapter, okay? But our goal line, guys, is to finish this chapter, and if you don't mind me saying, we're going to try to we will try to finish this chapter. How's that? Okay? That's grand aspirations. Have a good night. Thank you for sticking with me.